Before we begin, a disclaimer: this podcast is for informational and entertainment purposes only and should not be relied upon as the basis for any investment decision. Nothing you hear is an offer or solicitation to buy or sell any security. The securities discussed on this podcast may be owned by persons being interviewed. Before making any investment decision, please consult an investment advisor. All right, so for this episode, we have a few topics here. We also have some questions. We can take this in any order you want, MBI. So I'll turn it over to you.
Start with something that you have written very recently, global payments. And I was reading your piece on global payments, and you've written a lot on payments over the years. I think your payment series was kind of like a must read. I feel like if anyone wants to get up to speed on payments, and I was reading your global payments piece, and I was like, oh my God, this is such a shitty company. and then like at the later half of the piece, I was like, oh, he's now sounding positive because the valuation has been kind of, it has been shot. The company has been shot by the investors already. So you don't have to shoot again, right? So,
yes.
So yeah, like, I was kind of curious about your, maybe thoughts on global payments, but also, this kind of tension that you find this plethora of, examples where the capital allocation has been probably less than ideal, acquisition spree, which turned out to be not as great, and management changes. And you, I think, specifically mentioned you only get to hear the true story of how acquisitions actually went when there is a management change. The next management team basically just throws the previous management team under the bus, and the investor community gets to hear the real picture behind the curtain, and in terms of how those acquisitions actually went, how those synergies didn't quite materialize, or maybe some of these indeed materialized, but it opened up new Pandora's boxes, right? So, talk about that tension of, investing in companies, looking at companies where they have all these hairs, and then you look at the valuation and you kind of have to feel compelled by the level of pessimism embedded in the price. I'm curious to hear your thoughts on that.
Let me just, I guess, give a brief overview of the situation because it's a bit complicated.
It is complicated, yeah.
Yeah, and for the uninitiated, I think this will be helpful, and it's going to be radically simplified, and you can read my post for more nuance. But so basically, when you go to the store and you buy something on your credit card, and let's say that credit card is issued by Bank of America, there's two sides to that transaction, basically. There's the merchant side, and then there's the issuer side. So when you swipe your card, there's a processor in the background on the merchant side. It'll be someone like, First Data or Global Payments or Adyen that authorizes the transaction, okay? And then there's also a processor on the side of the bank that issued your credit card. So this would be someone like FIS or TSYS that processes the transaction on behalf of, Bank of America and checks to make sure that, you have enough money in your account or that you haven't run past your credit limit. And if everything's fine, they approve that transaction. Okay, so you have essentially your merchant acquirer, and then you have your issuer processor. And there are these, legacy behemoths that do processing on both sides. And these companies have origins that date back to like the 70s and the 80s, like the early days of credit cards. And most of these were actually spun out of banks, and they've grown through, tons of M&A over the decades. And they each run, a bunch of platforms that aren't particularly integrated well, lots of tech debt, lots of spaghetti code, the usual stuff that you expect from these incumbents. And so, now let's focus on the merchant acquirer side. And so the big legacy vendors here, it's companies like First Data, it's Global Payments, it's WorldPay. And, traditionally, the way these companies would sign up merchants is through, partnerships with banks or through ISOs, independent sales organizations. So if you were starting, let's say, a deli or something.
Uh-huh.
You set up a business bank account, and the bank would recommend, First Data as your merchant acquirer, or an ISO, uh, which is usually a small business staffed by a few people. They come into your deli store, and they try to sign you up for First Data or whatever merchant acquirer they happen to represent, right? But there was a big shift starting sometime around, let's say 20 2010,
Ah,
where you had a lot of modern merchant acquirers and PayFacs emerge and bypass those traditional distribution channels and offer a much cleaner onboarding experience. And so
right.
Stripe is kind of the famous one, right? They gained traction through developers, and they sold
Yeah.
through an API to businesses taking payments online. Um, or if you're running that deli store again, you could buy um, a Square terminal at Best Buy or order one online. Um, and these newer companies that emerged, they had much more, unified platforms. They weren't built through tons of M&A. Adyen famously has, a single platform globally, in contrast to someone like WorldPay, who runs, dozens of different platforms all over the world, right? And so global payments, it's one of the legacy merchant acquirers. Okay. And they have a history that goes all the way back to the 80s, and they used to distribute through banks and ISOs. And then as software began eating the world, they started distributing through software vendors, meaning their payment services would be embedded within the software that merchants use to run their business. So if you're a dentist, you might have, a practice management software, and that software would then integrate with Global Payments. And so starting in 2012, Global Payments, they started making a bunch of acquisitions in this area. Um, and to put a name to it, they call this like integrated payments, embedded payments. We don't need to get into nuances of what those are. It's just important to know that, like, under this model,
Yeah.
payments is being distributed through software vendors,
Right.
essentially. But
Hmm.
none of these acquisitions um,
But those
were,
ISOs still, like the traditional way of distributing, still existed, or they completely kind of supplanted by
oh,
software.
they're still around,
Right.
and they make up, I forget the exact percentage, but they have, maybe it's like a quarter or a third of the merchant services revenue. But these acquisitions, they weren't particularly integrated well together, and it was probably more accurate to describe Global Payments as like a holding company. And I think it's also fair to say that they paid too much for some of these acquisitions during the SaaS craze.
Sure.
Um, and yeah, and again, they, alongside all the software stuff, they also had the legacy distribution as well. And so then, sometime around 2019, you had like a series of mega mergers between these legacy merchant acquirers and these legacy issuer processors, right? So FIS merged with WorldPay, Global Payments merged with Total Systems, Fiserv merged with First Data. And, like the new FIS and Fiserv had like $100 billion enterprise values. Global Payments was around 60 billion. And the way I mean, I guess I would describe this as like a desperate attempt to remain relevant through scale, essentially.
Uh,
Like they couldn't really compete with Stripe or Adyen on the basis of product or, onboarding experiences. And they really, they pretty much gave up trying to integrate all these different platforms a while ago. And so they essentially just resorted to being bigger. And there was also, some strategic logic to, um, possibly realizing higher authorization rates by owning the processors on both the merchant side and the issuer side. But those honestly never seem to have really panned out. And so FIS's merger with WorldPay was a disaster in some ways. They took an $18 billion impairment on the merchant services side. And then a few years later, they sold a majority stake. FIS sold a majority stake in WorldPay to private equity. And now what's happening is that Global Payments is acquiring 100% of WorldPay and
uh,
funding that in part by selling their issuer processing business, which they acquired through their mega merger with with Total Systems. They're selling that to FIS. So this is super confusing.
my God.
but,
Like
but
I read
basic,
your piece and I'm listening to it and my head is like kind of spinning, just thinking about, okay, who owns what? And like, it's all over the place. And it actually reminds me
yes.
of something, Shift4 CEO and founder, Jared Isaacman. He
Hmm.
tweeted it like maybe a couple of hours ago. He said something like, uh, these companies, I think these companies, as in, Global Payments would probably be part of this, provide a commoditized service and are generally all hemorrhaging share. They
Yeah.
pursue M&A out of desperation, buying companies in a similar situation to their own, believing scale and cost synergies will make up for a lack of product differentiation. I think that probably sums it up pretty well in terms of what kind of happened, since, let's say, early to 2010s in this industry. And yeah, they are probably praying at this point that by being larger company, by acquiring a bunch of this kind of companies, they will find relevance, as you put it.
Yes, exactly. Yeah, I saw that tweet this morning. I thought, yeah, that kind of nails it. But so it's
Yeah.
very complicated. But but just to put this in a nutshell, what you used to have is two companies, FIS and Global Payments, and each of those companies had a merchant acquiring side of the business and an issuer processing side. And then after this transaction, Global Payments will be a pure play merchant services and FIS will be a pure play issuer processing business. Okay. So from an industry level standpoint, this is better than what was on offer before. So like now you have like two big companies, one that does issuer processing, one that does merchant acquiring, and that's better than having two huge companies that each do both.
Right.
Basically,
Yeah.
right?
Yeah.
Okay, but that doesn't mean that this is a good transaction for Global Payments in an absolute sense. It's better than it was before, I think, but I still don't think it's a
yeah. Shifting
it's
from
great
worse to bad is still like an improvement, right?
Yes, because the thing you got to understand is that prior to this acquisition being announced, Global had a new CEO, and the agenda was all about like returning capital to shareholders,
Yep.
simplifying the business, organic product development, no more transformative M&A. Right? And then like less than a year after
transformation arrives.
yes, exactly. Less than a year after they said that, they do this massive deal, right, with WorldPay, and then they add like the mother load of all like integration distractions to their plate, and and also like in the prior few years, Global's merchant services growth started decelerating, and they paid like some dumb multiples for software acquisitions at the tail end of the SaaS craze, and so look, with all that going on, the stock lost half its value over the last 5 years, and now it trades at like 7 times earnings, and that seems to be that seems to price in irrelevance, and I don't think that's how this will play out for a few reasons. First, I think like they were at least directionally right in pursuing the software-led distribution,
right?
And today that makes up about half of their merchant services revenue pre-WorldPay. And that should be growing, high single, low double digits over the medium term. They have active relationships with thousands of ISV partners, and the revenues here are pretty sticky. Clients typically retain kind of in the 90s, in the 90% range. The second thing that they've done is they've consolidated the 16 or so POS systems the point of sale systems that they used to have under a single modern brand called Genius. So this is very similar to what Shift4 has done with SkyTab. They used to have 4 or 5 different brands. They consolidated onto a modern platform. Now, having said that, they don't have, like, Global Payments doesn't have a strong track record for organic product development, but it's at least a positive sign that they're trying.
Right.
And then the third thing that they do have, which I think is important, is they have distribution. They have the right kinds of distribution in the right places for Genius. So a while back, they acquired this company, Heartland, which gave them a large direct sales force. And then a few years ago, they acquired another company called EVO Payments, which gave them bank partnerships overseas. And bank partnerships, as we talked about, they're less relevant in the US because all the distribution has moved to software. But they're still relatively more important in overseas markets. So basically, like, the way I see this is like, you're taking legacy Global Payments, which should be growing high singles. You're smashing that into WorldPay, which is growing like mid singles. So the combined entity, I'm thinking, should be growing, let's say 6-7% organically. And then there are the cost synergies, and they're returning a third of their market cap back to shareholders over the next 2 years. So if things go according to plan, you're essentially paying like, 7 times this year's earnings, with EPS growing, let's say, low teens over the next 2 or 3 years. And like, look, there's a lot of ways this can go wrong, of course, in terms of like execution. And there's some leverage. It's like three turns of leverage, but also it's like I look at this and it trades like some dying specialty retailer or something. And it just and I think there's just a discrepancy between where it trades and the quality of this business. I'm not saying it's a high quality business, but it's not a dying
Right.
business. It's growing, it's sticky, it's recurring, and I just think it's like too cheap for what
Yeah.
it is. And
Famous last words,
yes,
too cheap.
exactly.
Okay, so I have a question. So, how does the management get paid? What's it like incentive system aligned? Is it with stock price? Is it some, I don't know, operating metric?
There's nothing particularly unique. I mean, it's like, performance stock units that are tied to EPS and total shareholder returns. And then there's some stock options.
I mean, doesn't have to be something mind-boggling. If it's like PSUs with EPS and like total shareholder return, that's fine. Not that that's actually pretty optimal. Yeah, that's what typically it is. But I think it's still the fact that they are getting paid in stocks and options is a good sign. But do they own again? Like if I were running this company and I know, oh my God, in 2-3 years down the line, my company is going to be trading at like 4 or 5 times. Uh, I would probably buy stock from the open market, or maybe I would just say, give me more options, right?
No, unfortunately, there hasn't been haven't
Okay.
been any significant insider buys that have come on the radar here. This guy, he's not like some outsider who just came in and took. He's been at Global Payments for a very long time. The current
I see.
CEO. He's
Yeah,
kind of part of like the old guard, the old institution. So I don't. It's not like a bet on this guy sort of,
for sure. Yeah.
really doing something radical. He needs to stay true to his commitment to return cash to shareholders. He can't do any more massive
Right.
destructive acquisitions from here. And then I guess the one thing that you are sort of making a bet on is the Genius POS platform. Like you want to
Uh,
see some traction on that, and they don't have a strong track record in organic product development. So that's a bit of a bet I think you're taking. Historically, I've focused more on like the higher quality
sure.
type businesses. So this was a little bit of a deviation from that pattern. I
You
do think
have to
it's like,
deviate when Sharon Williams is trading at 30-35 times PE. You can't really stay stuck with the high quality stuff for forever.
yeah,
If you want to deploy incremental capital, the market is kind of forcing you to, go down the ladder in terms of quality.
yeah. And I mean, I think it's, very helpful, obviously, to have a deep appreciation for like what a really good business looks like.
Mm, mm,
And that sounds weird to say, but like, honestly, before I started studying these great businesses diligently, I didn't have that frame of reference. So I'd often think like crummy businesses were better than they were. And
mm.
like on Twitter, I saw someone tweet that Teladoc had incredible network effects that were even better than Visa's, right? And so like a statement like that could only come from the mind of someone who's never actually taken the time to understand Visa,
Visa,
right? And
yeah.
so
Yeah.
it's helpful to actually like research these businesses, even if they aren't good investments. But having said that, you don't want to then delude yourself into thinking all great businesses are great investments. And so,
Mm, yeah.
yeah, like when it comes to investing, I think it's just good to get into the habit of thinking, not just, is this a good company, but am I paying an attractive price relative to the quality? And I also think like just generally, it's it's healthy to foster a state of mind where you can like make fun of the companies you own. I mean,
Yeah.
it's sometimes funny like how defensive people get about their stocks. Like you raise doubts and concerns about a stock someone owns and you think like you insulted their kid or something. And like, yeah.
But yeah, no, even to your point, I think it's true that I actually started studying like U.S. companies with big tech, right? So that those were kind of my first few companies I spent more time on
Yeah.
understanding the businesses, and I would say uh, I appreciated them even more over time after I spent more time understanding non-big tech companies, right?
Yeah.
And then I'm like, studying and like model these other businesses, like thinking, oh, can they grow like from 7% to like 10%, like 300 basis points of incremental, revenue acceleration. And then you look at big tech and, Azure, is posting more than 30%, revenue growth for the last like 10 years,
Yeah.
every quarter. Like, this is absurd, right?
Yeah.
And the absurdity is hard to appreciate unless you actually look at some, non-great businesses, right? So,
Yeah.
yeah, I agree. I agree. I think that has been part of my lessons as well. Like just by looking at different companies from different industries at varying like level of quality, I think it definitely helped me appreciate uh, the true high quality businesses a bit more, right? But as I said before, unfortunately, a lot of other people also came to that realization, and the prices have gone up for these higher quality businesses.
Yeah.
At least these days. But these are cyclical things. Even people forget about the quality of these businesses when there's some like tension in the air. So who knows? But
Yeah.
yeah, let's move on to
Yeah. Well, I
something.
did want to say one thing is like,
Sure.
um, I was hoping to see in the proxy some measure that was tied to like return on invested capital, given how acquisitive they've been over time. But
David, you got
obviously
high
no.
hopes.
Yes. So that was never in the proxies in the past, and
Yeah.
it's not part of the proxies now. But on the other hand, they're kind of claiming to be less. They claim to have taken like M&A sort of largely off the table, so maybe that's less of
Mm.
a concern going forward. But
Just even the companies that want to track ROIC for the incentive system, they typically just define ROIC in such a
yes,
way that
exactly. Yeah,
completely
yeah,
bastardizes the
yes,
metric, right? I think you pointed out, I think one company is called Biotechne, if I'm not mistaken.
yeah.
And
Right, right.
they had ROIC kind of, as a measure in the incentive system, but the way they kind of defined it is completely ridiculous.
I think if I recall, they add back like amortization
Yeah.
and depreciation or something in the numerator, but then they use like the gap measure, like a gap measure of
Invested
capital
capital, yeah.
in the denominator.
Completely like apples to oranges.
Yeah, yeah.
Uh,
So people can play games with that metric as well. Yeah, definitely.
Yeah, speaking of people, thinking of quality businesses in different light, in different environment. So software, which was supposed to eat the world, now is in the crosshair these days. Now
Yes.
AI is, uh, thought to be eating software, right? So there's a lot of concerns, there's a lot of debate, there's a lot of, I would say extreme arguments made by some people like, oh, AI is going to destroy software's margins, like these current incumbent businesses will not be able to transition from this period and go to the promised land of AI, right? So
Yeah.
so I'm curious, like I know you also publish a piece on a bunch of software companies like I think mostly HCM, so
Yep.
Workday, Dayforce, which just got acquired. So yeah, like how do you perceive this narrative of software being increasingly commoditized thanks to AI?
Maybe I'm just not thinking creatively enough, but I mean, I think first on the disruptive impact of like, vibe coding and bringing the cost of development to zero. Um, where I come down on this is like, I don't think it's not a material risk for like systems of records like,
Uh-huh.
Salesforce and Oracle and Workday, because what enterprise buyers of that stuff care about is avoiding operational and reputational risk. And there's also, huge ecosystems of support and integrations built around those centers of gravity. And so, yeah, the analogy I used in my Workday post was to say that like the flood of vibe coded SaaS startups are going to usurp Salesforce is a bit like saying you can kill King Kong by shooting him enough times with BB pellets, right? I actually, in fact, I think like a more plausible scenario may even be that those incumbents use advancements in AI coding to more productively move down market. Like
Right.
the
Yep.
classic maturation path is that you start down market and then you climb up market. And then it's hard to make the reverse commute because your cost structure has adapted to serve enterprise clients. So that's like classic like Clayton Christensen, obviously. But
Hmm.
like, maybe these new dev tools make that move more plausible. Vertical management software, that's another domain where I don't expect too much disruptive impact. I think vertical VMS, it's like a system of record in some ways. And I think it's important to recognize how much tacit knowledge I think gets codified into these systems over a long period
Mm.
of time and how like compliance heavy they can be. So like when I think about a company like Viva, right? So like in addition to the pharma CRM, they also sell software that's used to manage and audit the data from clinical trials
Yep.
to demonstrate that the trial was conducted according to the FDA standards, and that and to make sure that the data gets reported to the FDA in this very specific way. They also have software that's used to manage these trials. So like an investigator can click into any of the trial sites and see how quickly it's enrolling patients, if there's
Right.
like any deviations from the trial protocol, whether it's staying on
Yeah, it's
budget, that kind of
highly
stuff.
regulated. Like it's not the stuff that you would uh vibe code and hope for the best, right?
Yeah, that's right. And there are just so many apps that tie into even that core stuff that keep track of all the documents, the supplies, any meaningful event in a clinical trial. And yeah, I just find it hard to believe that IQVIA or like any CRO is going to vibe code something like this on their own. And but where I do think like there could be like tons of brutal competition for the incremental customer is like in
Mm.
areas where there already is, like SMB, non-mission critical SaaS, like a talent management app, like project management, task management, note taking, like that kind of stuff. I can certainly see, but I also think that those are like viciously competitive domains today. You know,
Yeah, yeah. I mean, you definitely make an interesting point that uh these incumbent software companies will have an easier time to kind of go down market. Uh, it reminds me of so I guess Brett Taylor makes the opposite argument. And just for context, he used to be the former co-CEO of Salesforce, now co-founder of Sierra, no, a AI startup company. And he made the argument, I think, with Ben Thompson, that he was saying basically it's actually easier for a technology company to go through a technological transition, but it's
yeah,
harder to go through a business model transition, because the argument he was kind of implying that there's so many stuff that changes when you're trying to go through a business model transition, like the way your people get paid, the way the accounting works, like, and even for some, like, for example, Adobe. Now we kind of thought it's business as usual. Like, you used to be, perpetual licensing, in perpetual licensing model, you transition to subscription model. What's the big deal, right? But if you actually read the history, and how they were thinking, they were actually pretty nervous that, and they want to make sure that Wall Street analysts, investors understand that there will be some, like, kind of a weird period. The
yeah,
financial statements and earnings will look, somewhat strange for like a couple of years as they kind of go through that transition. But on the other side of it, they will be just fine, and in fact, their business will be better, right? So, to Braid's point, that it's actually a lot harder to do than just go through a technological transition. He also
yeah,
talks about, like, how the pricing model, like, in current SaaS environment, we are basically a lot of these businesses are basically priced per seat, right? Or even usage, right? But what Sierra talks about, what Brett Taylor talks about, is pricing is increasingly going to be based on actual outcome, right?
right.
So it's not like, oh, I'm a salesperson and I'm using CRM, so CRM gets paid, like, I know, certain number of dollar every month just because I'm using CRM, right? But what Sierra talks about is basically, Sierra only gets paid when there's an actual sale that's happening, right?
Hmm.
Uh, and to his point, that it's going to be a lot harder transition for a lot of these, incumbent SaaS companies to kind of go through that. So I'm curious. I wonder if you have any thoughts on this particular point that yes, I don't disagree with what you are saying that yeah, theoretically it should be easier for these large incumbent companies to go down market and uh, fight much harder for the for incremental customers, but at the same time the competition from these like AI startups who are coming up with like not only a different technology but also sort of different pricing strategy. So yeah, do you sense there is something there? There's
Yeah,
something
yeah.
to
No,
be
I think
worried
that's a
about.
totally valid argument. Yeah, it's just it's this argument that startups take the new thing more seriously than
Right.
incumbents, and they build their organizations around it in a way that incumbents can't for legacy business model reasons. But
Um,
I got to say, like across the board, it just seems to me that like every hyperscaler and SaaS incumbent is just speed running towards AI. Like I don't get the sense like, and all these companies are managed by people who've read The Innovator's Dilemma. Like the founders are still involved in
yeah.
many of these cases, or they're sitting on the boards. And the lessons that they've taken away from Christensen, it's not like a fatalistic one where they're destined to be doomed, but it seems more like we need to kill sacred cows if necessary to guarantee our future. Like AI, it's like the number one priority, hands down, for tech companies across the board, and no one is like being lazy or about it
Yeah.
or resting on their laurels. And it just feels like everyone is in such firm agreement that this is going to change the world in a discontinuous way, that to
Right.
not go after this as hard as you possibly can for the sake of preserving an existing business model spells like certain doom. Um,
Yeah.
yeah,
I mean, I sometimes think about like if I were Mark Benioff and let's say I'm waking up and I'm like going through newspaper articles and like blogs and like Twitter feed and stuff like that. I mean, if you think about it, if I were Mark Benioff, I would actually read a lot of stuff from outside world telling me how Salesforce uh, is not going to be able to transition to this new world, right? People are
yeah,
constantly telling me, and if I were the founder, you think I would just stay idle? I don't think so. Like
right,
I think to your point, every single incumbent is viscerally aware that this can disrupt them, right? So it's
yeah,
not like, oh, this thing will come probably in 3 years, 5 years down the line. Like by that time, who knows where we will be? Maybe I'll retire by the time. Nobody seems to be thinking like there isn't. As I think you pointed it perfectly that there has been a firm agreement among everyone. AI is a
yeah,
big deal. Like back in like I don't know early 2000s, like in during tech bubble, after at least after it crashed, I think there was a period where people are like, this is a fake thing. Like an internet is not like it went too far. It's it had inflated expectations. Maybe we may experience that for AI as well. There are definitely corners of the market or investors who think that AI is fake, like it's totally
yeah.
bullshit, right? And maybe they will become a lot more vociferous if there's like a big crash, right, in the AI land. But we haven't seen that yet. Now we are
Yeah.
still in that environment where we're every incumbent software companies are being constantly told by think boys, bloggers, like you name it, analysts, right? Like, hey, you guys are probably doomed, right? So,
Yeah.
yeah, I don't get the impression that anyone is being lazy here.
I think my opinion on this would be different if these companies were run by, like Renta CEOs and the founders were, checked out a long time ago.
Mm,
But I think there is just something um like fundamentally unique and interesting about having like a founder still like intimately involved in these businesses. Like I think there's just a sense of like urgency and risk taking and like killing of sacred cows that you get in those kind of companies that you won't find in like an IBM or an SAP or something like that, right? Um, so yeah, that's just kind of my preliminary views on this stuff. So much is changing so fast, but basically,
yeah.
like I look at this, it's like all these enterprise software companies, they seem to have basically the same initiatives. Like they're using AI to operate more efficiently. They have the chat bots, they have the agents. They're all monetizing it to varying degrees. And they all say they have to have the cleanest data. They have the cleanest data for the purpose they're serving. So
Mm,
I think we're at the point where like AI is table stakes, but I don't. I'm not necessarily convinced that it's like a differentiator. Like an
mm,
enterprise buyer is going to pick Salesforce or Workday or Oracle, not because of AI, but for like the usual non-AI related reasons, I think at this point. And then they'll pay like extra for the agents and chatbots and whatnot. So I can see like AI being sort of like an ARPU lift over time, but not the decisive factor for why one enterprise picks
Yeah, I think if I
Salesforce over
remember
HubSpot
correctly,
or
what you mentioned explicitly that you think, or maybe sorry, maybe that was my interpretation. Like you did say that AI is probably going to be an ARPU lift, uh, but one of my interpretation was yes, it will probably be an ARPU lift, but it may not be a margin lift, right?
yeah.
If everyone has the same sort of like features and like capabilities, then you may be able to charge a bit more because you are offering them better or more features, but your ability to kind of generate higher margins can be limited if everyone else does that.
Well, but if you're picking a platform for non-AI related reasons, like you're saying, okay, I'm going to pick Salesforce because nobody gets fired for buying Salesforce.
Mm-hmm.
You're going to be stuck on, even if Salesforce starts to charge you for their agents. I don't know if that's going to be enough for you to like switch to an alternative to Salesforce. Like I think you're at Salesforce, you're stuck there for the usual corporate reasons. And once you're stuck there, I think someone like Salesforce can take some margin from
Extract
you.
margins. I mean, yeah, that is definitely a possibility. I do think maybe that's why, as you are saying, that if someone doesn't pick Salesforce, it may be because of non-AI reasons. Uh, I wonder if that's where the business model transition comes in.
Yeah.
Like for someone like Sierra, they have no business in beating Salesforce by playing in Salesforce's terms. But if someone comes along and say, hey, we don't believe in seat-based pricing, these are kind of old anachronistic business model. You make money, we make money, right?
Yeah.
And that seems so much more compelling. And maybe that's where the risk may be. Like it's harder
Yeah.
for a public company to kind of respond to or like change their whole structure radically in a very short time to and try to respond to that. I think so. Brad Taylor was saying that everyone at Sierra, every salesperson at Sierra is supposed to like run a deep research before every sales meeting to kind of get up to speed, what's going on, and everything. And the point he was making, he couldn't possibly do that at Salesforce. There's like
Mm.
thousands of people, salespeople
Yeah.
at Salesforce, and they may sound serious. They may say, "Yes, you have to do this," but it's really hard culturally to make sure that 10,000 people are on the same page. But it's a lot easier if it's like tens of people to be on the same page, right? Yes, and I don't I don't yet see AI being like a terminal disease for incumbent software
Mhm.
companies. Uh, but I'm kind of in a limbo. I'd say if I think from investors' perspective, I feel like I'm a lot more in the middle. Like I don't see that is it as a terminal disease. A lot of incumbent software company will do just fine. I think on the other side of it, but also I do sense there's something there. There's definitely some risks there. Like if you're not careful, if you're not paying attention, if you are slow and let's say a new set of AI startups come to your kind of space, it can turn out to be a bit nasty for you, right? One of the risk that's out there is, and a lot of the software companies are actually, if you look at their like earnings power, true earnings power, like they're still kind of not cheap, right? So, for example, Workday, everybody talks about Workday. Like if you look at their gap earnings, they're trading at like I don't know, like 80, 90, 100 times gap earnings, right? So obviously, you wouldn't think that people are talking about uh, AI being a terminal risk for them. But obviously, like, people talk about, oh, their margins are not optimized. All that is fine, but it can be quite tricky when you are trying to navigate through, let's say, a business model transition and a technological transition, and you also need to be able to raise margins and also need to be able to maintain your top line growth trajectory. Like those three, four things to do it simultaneously can be quite challenging.
Yeah. Yeah. I will. I guess we can move to this second topic here, which
Sure.
you introduced. Commentary on OpenAI and Anthropic
Anthropic.
valuation.
Yeah, so obviously there's a lot of talk among investors whether AI is in bubble or like obviously if you think it's a bubble, then the next question is when it's going to burst, right? Uh, and I have this sense that if there is a bubble, uh, you know, I don't quite see it in the
Hmm.
public market yet. I mean, there is one path where it may prove to be bubble. Like, so if you look at the earnings power for big tech, they look just fine on purely earnings metrics. Like, yeah, probably a bit on the higher side. But if you look at their, like I said, revenue growth, like, yeah, Meta is growing at like 20 more than 20%. Revenue growth. So if they are trading at like high 20s, low 30s multiples, earnings multiples, that doesn't
Hmm.
me as some like bubble indicator. But that's earnings, right? Free cash flow is completely opposite, right?
Hmm.
So the one way it can turn out to be bubble, like if all this capex that big tech is investing turns out to be, doesn't generate much return, doesn't generate any reasonable ROIC, then the earnings will prove to be inflated, depreciation will keep rising, and the earnings growth that is embedded right now in these stocks will not materialize, and we may go through some downturn. Even then, when people talk about crash, like look, uh, during tech bubble, Nasdaq went through 80% drawdown, right?
Hmm.
I would say there is almost no scenario, with probably only one scenario I can imagine is China invading Taiwan. If that doesn't happen, I would say there's almost no scenario in the next like 3-4 years we'll experience 80% drawdown from this current, let's say, level. Uh, but there is one market I see. I can sense there is probably plenty of scenarios where it can happen. There's like 80% drawdown, and that's like OpenAI and Anthropic. OpenAI is being currently valued at $500 billion, and Anthropic is at like $170 billion, right? And OpenAI so far raised like 58 billion. Uh, of those, 40 billion is basically from SoftBank, which hasn't really come to the company yet. I think it will gradually be raised in different tranches throughout 2025. But overall, if you include SoftBank's capital, total capital raised by OpenAI is 58 billion. For Anthropic, it's like 35 billion. Again, they have like, but it's the total capital raised. I'm including debt as well, not just equity. I was actually curious how much Google raised before going to IPO. It actually raised, like including IPO, I think 1.5 billion. And I still vividly remember one particular stat. I think back in uh, mid 2021, probably April or May 2021, I remember looking at Google. I was shocked that if you bought Google on the day iPhone was announced uh, and held it till, let's say, I think April 2021, uh, you underperformed NASDAQ 100, right? And the question that I was wondering, imagine what has happened since iPhone was launched for Google, right? What did they do? They uh, they had a great deal with Apple. They had a default distribution. They transitioned from desktop to mobile really well. They aced it. YouTube became a global phenomenon, probably the most durable consumer internet asset in the world, YouTube, right? Then you have cloud business, you have DeepMind, you have Waymo, all this stuff that has happened in the 15 years since iPhone was launched. And as an investor of Google, you slightly underperformed NASDAQ 100 return, right? Uh, since then, I just checked. Since then, now Google is ahead of Nasdaq 100. If
Hmm.
you bought, like you probably did fine. But April 2021, that wasn't like it's not like Google was down a lot or anything, right? It's just Nasdaq had such a great run that the index itself had better performance than pretty literally the generation defining company.
Yeah.
When iPhone was launched. The point is, I think a lot of people have this idea that, oh, it's very easy to see OpenAI is going to be this kind of generation defining company. Well, Google was. And imagine how many things they had to achieve
Yeah.
and still not, make as much return as Nasdaq 100. So I think, people underestimate how much, people are implying that OpenAI will achieve in the next like 5-10 years. Like they probably need to hit AGI at this point if
Yeah.
they want
I
if they
mean,
want to
but
generate good return.
I always feel like one of the most confounding aspects of a conversation like this is that like I don't have like a strong theory for like why these models are as effective as they are. And I don't know that anyone really does. And without a theory, it's sort of hard to make high confidence extrapolations. Like people will sort of hand wave this away by saying, well, compute is all you need, right? But
Yeah.
is it? Like we don't actually know when it comes to like kind of human like general intelligence everyone is worked towards, if that is all you need. Like it would be extremely weird to encounter someone who could multiply two numbers together but couldn't add those two numbers together, because like the way humans work is like we have these conceptual blocks that build on one another, and that's not how LLMs work, right? And so there's like this dynamic where like AIs can be like unpredictably dumb, right? Like they're exceptional in
Mm.
some tasks, but then
Yep.
fail in other tasks from a human perspective that are no more conceptually difficult to accomplish. So there's kind of like two sources of uncertainty to like any technology. Um, there's like the theoretical understanding of how the technology works, which allows us to like deterministically extrapolate, like, hey, if we jigger this thing, then the output is that, right?
Mm-hmm.
And then the
Mm-hmm.
second source of uncertainty is like the implications of its adoption in broader society. So like with the internet, we had like a very clear theoretical understanding of the technology underlying it, but the societal implications were unpredictable. Like you couldn't have predicted Airbnb 25
Yeah,
years ago, whatever. Or
for
like
sure.
take nuclear energy, right? Like
Yeah.
we understand perfectly how that works. You split the uranium atoms, that releases the neutrons, that splits more atoms, that generates heat, that boils the water, water turns into steam, steam turns a turbine. But we don't have like a similar like deterministic understanding of AI, and therefore we
Mm-hmm.
can't really like clearly draw the bounds of that technology. So there's like these two huge sources of uncertainty with AI. It's like the theoretical underpinnings and like the societal implications. When I think about this stuff, I just have a very hard time like understanding the shapes of these distributions.
No, I think you probably put it the right way. The distribution of outcome, it's harder to uh, wrap your head around uh, when one of the potential outcomes that serious people talk about is AGI.
Right.
Uh, so, and even like when I was spending some time on this company called Cursor, and so Cursor basically, I would say in the VC world, it's probably one of the most consensus companies in the AI space. In fact, to the extent that I have seen people pitch their startup as like Cursor for X, right? And I was, when I spent some time on Cursor, I'm like, wow, I am a public market investor and I rarely came across a $10 billion company that seems as fragile as Cursor is. So, so they are heavily dependent on the, SOTA model developers like Anthropic, OpenAI, XAI, right? And so they have no control over their suppliers, and their suppliers themselves want to, beat them, right? Want
Yeah.
to develop a better product. And the suppliers have a lot of pricing power over them, and their best hope is basically to be able to pass that to the consumer.
That's almost like a third uncertainty, right? So there's like the technology uncertainty, there's the uncertainty as far as like the broader societal impact and all this kind of stuff and the
Yes,
TAM.
yes.
And then there's competitive uncertainty.
Yeah, I mean, even for like, it's a bit tangent, but I think a lot of people say, oh, If the AGI is here, you'll be fine if you invest in big tech or whatever, right? I'm like, okay, what is Meta's business model again? Isn't it advertising? And who's advertising? It's people like you and me and like, the SMBs in the world. And if they all got completely, shut down by AI, like who is
Yeah.
advertising on Meta, right? So will Meta have to charge us to spend our whole day watching reels and stuff like that?
Yeah,
Like,
and it's that exactly. So this is like and there's no way to do this from the outside, but like ideally you would want to distinguish between like growth and maintenance investments with all this like CapEx where it's like or even
yeah,
look at the investments on a cohort level basis where it's like, okay, here's a ton of investments being made into this model, and then here's the NPV of those investments. But instead, like when we see like OpenAI is generating however much revenue, but also losing billions. I think you
yeah,
wrote about this. Like those billions reflect the growth investments, but it reflects like the growth investment being made in the new models as well, right? So in
right.
one sense, you can say like, well, the income statement combines like very profitable investments with new investments that have yet to generate any revenue. But in another sense, like all these guys seem to be like believers in super intelligence and they're all working towards that. And so at the moment, there seems to be this idea where, like, okay, we'll have a lot of different models that are better or worse at different things. But if you're a believer in super intelligence and like extreme takeoff scenarios, well, then that sort of turns this into like an extreme power law where like maybe you have like one
Yeah,
model that takes most of the value. And then for all the other research shops, that final 100 billion or 200 billion or whatever they invested in the most recent round
it's all
of,
zero.
of investment, that goes to zero.
Yeah.
And that wipes
Yeah.
out all the profits that were earned on all the previous models up to that point.
Yeah, I mean, so that's why I actually thought, so Dario Amodei went to this podcast with John Collison of Stripe, and he had this interesting point of view about how he thinks about kind of profitability. And he was saying, hey, look, all of our models are profitable if you just
Right.
consider it on model by model basis. So we spent, let's say,
Yep.
$300 million on this model. We generated $300 million or $400 million. So we are profitable, right? But the thing is, we already invested like $500 million for the next model, right? And his point is, once we know the final model has been run, we'll be able to, then we don't have to run the model anymore. So, and it will be on the inference and, it will be a very profitable business. And my immediate reaction was that, wait a minute, if we all know the final model has been run, who do you think will benefit the most? The one that has the lowest cost, right? Like
Mm-hmm.
if you're Google, for example, and you know that, oh, we have reached the ceiling. It's all over. There's no training run required. And you already know who has what cost. You have, let's say, pretty high predictability. Like, okay, at what price Anthropic is completely out of the market. Like, we can just completely make sure it's going to die. And like all the other, let's say, three or four other sort of model developers, at what price they go out of business, or they become like a sort of commodity sort of margins. Once, I think it's a disaster in some sense if there is a clear way of knowing that the final model has been run. We have reached the final frontier. And in
Yeah.
that case, I think it will basically come down to the marginal cost, right? The inference and all that. And if anyone, like whoever has the lowest cost, would just speed run to that marginal cost as soon as possible,
Yeah.
to kind of to generate that kind of return, the kind of super normal return from the business. So I don't quite share Dario Amodei's view that once the final model has been run, it's just going to be easy peasy Japanesey, and you just milk the model, the final model, for eternity. And again, like as I was saying, a lot of people, I have noticed some VCs made the argument that, oh, this investors have no imagination. They're arguing about negative margins, but that always happens because investing, as growth kind of matures, you will get to better profitability. It's totally fine. You will
Mm-hmm.
reach scale, and as you gain scale over your cost base, your margins will inflect positive and it will become even much better than positive over time. if you look at some of this kind of even for companies like Cursor, it's not like they're like, their margins are Cursor or Ripley's, their margins are like not great, not because of high fixed cost. It's the lack of any power over the suppliers or lack of ability to kind of, control pricing. Almost all these, startups are being valued in obviously in ARR terms. ARR used to be annualized recurring revenue, but if you look at their churns, many of these AI startups churns have like 50% churn. So there's definitely nothing recurring about it, but they're being valued at a pretty rich multiple.
I think people are looking at this like it's not even like it's like multiples of revenue or multiples of anything don't really apply. It's more like probability, like
I see.
like
Yeah.
on a probability basis, like, oh, what's the probability that OpenAI becomes like, one of the dominant winners? How big is that market? It's like one of those
Okay.
kind of exercises where it's like, oh, if
Yeah.
this is like a $2 trillion, $3 trillion market and OpenAI gets like this percent of it, then it should be worth this much. It's kind of like in that
Yeah.
stage, I feel like where people are, um, yeah, it's everything we talked about, where the distributions are so uncertain and so all over the place that like,
Yeah.
that you almost have to. I don't really know any other way um,
Yeah.
to
No,
approach it, but yeah,
I
I don't know.
agree. I think that's probably one way people are thinking about it, is that they are thinking about the end result, end outcome,
Yeah,
and associating a probability, to it, and they're multiplying this two and think about, okay, how much, But the thing is, it's really hard to. There's no way to prove or disprove that end state
right,
number,
right.
right?
Yeah,
It's whatever you feel like it. Like I'm pretty reasonably confident that if OpenAI comes to IPO, I don't know, next week, it will probably pop to $1 trillion,
yeah.
right? And I used to joke about it for I would say few months ago, I used to actually joke, yeah, OpenAI if comes to IPO, it will be $1 trillion, ha ha ha. Now I am starting to realize that given the market environment, I'm like, oh, that's not a joke anymore. I, it does seem uncomfortable to me how much people are willing to just hand wave
Right.
for these, let's say, a couple of companies. Like as I said, I really want to highlight. Imagine what Google needed to achieve since 2007 to 2020. Let's say 2020s, right? They achieved all that, and they got to 1.5 trillion, 2 trillion. Now it's 2.5 trillion, right? And you are buying OpenAI at $500 billion valuation. And remember, they're not out of their capital raising need. They'll probably raise a lot more. So whatever
Yeah.
company you're buying, you are going to be diluted more and more and more and more unless you keep participating in all those rounds.
Yeah. Good stuff. Well, I think this is a good place to probably end it here. So yeah, I think we could probably save the other few things for next